Good morning and welcome to today's webcast, Employee Benefit Plans, Lessons and Strategies for Success. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And with that, I will turn it over to Theresa to get us started.
Great, thanks, Emily. Good morning, everyone, and welcome to our webinar, Employee Benefit Plans, Lessons and Strategies for Success. We have Jennifer Blake, Brett Addis, and Rick Wagner joining as our panelists this morning. They will introduce themselves in just a moment. We hope you find today's discussion engaging, relevant, and refreshing. I am Theresa Coluccio, a director in our employee benefit plan practice here at Moss Adams. After participating in this session, participants will be able to summarize the lessons learned from 2023 plan year audits to inform future strategy, discuss total reward strategies to boost employee engagement and satisfaction, and describe trends to maintain tax compliance and benefit plans, and explain how to adapt to changing workforce expectations and compliance. We want this discussion to be interactive and engaging, so as you're hearing from the panelists, please feel free to put any questions in the chat, and we'll do our best to address them, whether it's on the webinar today or as a follow-up from today's session. Thank you all for, before we get started and have our first polling question, I'd like for our panelists to introduce themselves. So starting with Jennifer, and then Brett, and then Rick, tell us a little bit about yourself and what you're here to talk about today.
Thanks, Theresa. Good morning, everyone. My name is Jennifer Blake, and I'm a senior manager located in our Spokane office. I started working at Moss Adams directly out of college over 22 years ago and have been auditing benefit plans ever since I started. I currently lead our Spokane office employee benefit plan practice and oversee over 60 plan audits annually, including 401k plans, defined benefit, health and welfare, as well as ESOPs. I also serve as a member on our firm's employee benefit plan executive committee, which is responsible for overseeing the administration of our practice firm-wide, which includes things like training, developing our audit methodology, and developing firm initiatives related to our EBP practice. And I'm happy to be here today to speak with you.
I guess I'll go. Thanks. This is Brett Addis. I'm a director at Moss Adams. I've been at Moss for, I think I hit my 2 years this week, Theresa, so big kudos for me. Prior to Moss Adams, I have spent over 20 years in the human resource and human capital space. Probably for the last 15 or so, have been within the technology and overall HR management consulting space, and I was a practitioner for a number of years before that. One of the key things that I'm going to talk about today, and you'll probably hear this from Jennifer as well as Rick a little bit, is really around some of the total rewards and benefits components. So one of the key focuses of our human capital practice is around working with clients to help them think through what their total rewards philosophy and strategy and various types of plans should look like. So we've got an exciting opportunity to talk to you a little bit about what we're learning and seeing in the space. Rick, over to you.
Thanks, Brett. Hi, everybody. Rick Wagner. I'm a director in our National Tax Office. I've been working with Moss Adams for about 5 years now. I'm an ERISA / compensation and benefits attorney. I've been working in this space for over 30 years now. I serve as I said, in national tax and address really everything under the compensation and benefits heading, and work closely with the employee benefit plan audit team, and from a technical support perspective. I'm going to be talking a little bit today about just the changing compliance landscape around qualified plans and identifying specific issues that people should be aware of, and some best practices on how to deal with those changing compliance challenges.
Thank you all for the introductions. And now it's time for our first polling question. Okay, poll number 1. What role do you play in relation to employee benefit plans? Please choose one option and make sure that you submit your answer to get CPE for today's webcast. So your options are: I'm a plan sponsor, I work with external employee benefit plan auditors, I provide services to companies with employee benefit plans, or other, and you can please share in the Q&A.
We'll give everyone just a few more seconds to respond here. All right, we'll go ahead and take a look at the results. Theresa, back to you.
Thanks, Emily. Okay, let's see. So our most popular answer is I am a plan sponsor, which makes sense for why you're here on this call. Okay, so let's jump into our topics. So Jennifer, let's start with a question for you. What were the most common compliance issues identified during 2023 benefit plan audits?
Sure, thanks, Theresa. I would say the most common finding we have really every year relates to eligible compensation and a plan sponsor not properly identifying eligible and ineligible pay codes and just making sure they are set up in the payroll system properly. Some of the more common mistakes surround year-end bonuses, fringe benefits, and other forms of irregular compensation. Some of these errors are just a result of a lack of knowledge by the plan administrator and not understanding, what should or should not be included. However, in other instances, the plan sponsor may have intended for or may not have wanted these types of pay to be included as eligible, and so they will intentionally exclude them. But unless the plan document specifically excludes these types of compensation, they need to be included, or the plan document should be amended. Another issue related to compensation that we often run across is just the use of miscellaneous pay codes that may have multiple types of pay grouped into one pay code. And this can be problematic because you could have both eligible and ineligible types of pay in the same code, and payroll systems sometimes cannot handle that properly. Another issue as it relates to compensation, and although it's maybe not as common, but in some instances we see where, the plan sponsor has properly identified, this code should be eligible, but they don't test and go that extra step to make sure that it's set up properly within the payroll system and that the system is properly calculating the deferrals from that pay code. I've actually run across this a couple times in the past couple of years where the company thought it was set up properly but didn't do that test to make sure, and it actually wasn't calculating properly. Another frequent compliance issue, of course, is delinquent participant contributions. We often see, this, I would say fairly often, and this one is a big deal because failure to remit participant contributions timely is considered to be a prohibited transaction between the plan and the plan sponsor, and that gets reported on the plan's Form 5500. I think there's continues to be a lot of confusion as it relates to what should be considered delinquent. And I think part of that confusion stems from what is stated in the regulation. If you read the regulation, it states that participant contributions should be remitted as soon as administratively feasible, but no later than the 15th business day of the following month. And that 15th business day of the following month is really not intended to be some sort of safe harbor for remitting contributions. And really the part that the DOL focuses on and what we look at when we're doing our audits is what is as soon as administratively feasible. During an audit, we'll look at the cadence of a company's actual deposit history to determine what is considered administratively feasible for them. And then anything outside of that cadence is generally considered to be delinquent and gets reported in a supplemental schedule. Obviously, if you do happen to have delinquent contributions, it's not the end of the world, but you will need to make participants whole by depositing lost earnings in their account. And on the DOL website, there is a calculator that can assist with that calculation of and how much needs to be remitted. And also your record keeper or TPA can typically help with that as well. Another common finding that we note during our audits are just participant deferral elections not being set up or changed timely within the payroll system. For most plans, a participant will log into a record keeper or TPA website to make changes to the amounts they want deferred from their paycheck. And then those changes get communicated to the plan sponsor via some sort of feedback file, which shows the updates that should be made to that payroll system for the next payroll run, whether that be a deferral change or a new participant loan deduction that should be set up. And we find that these changes sometimes aren't updated timely or they get missed altogether. And this is considered a plan operational error and then would need to be corrected by making some sort of qualified non-elective contribution to the plan on behalf of that employee. On the IRS website, they actually have a document called the 401k Plan Fix-It Guide, which covers some of these common operational errors, and it discusses how you can go about making those necessary corrections. And I highly encourage you to look at that. It's extremely helpful. If you just Google 401k Plan Fix-It Guide, you should be able to find it.
Yeah, I agree. That's a super useful resource for plan sponsors.
We use it often. So the last one I just quickly wanted to mention is that we sometimes see plans that don't have a retirement plan committee and or don't maintain plan meeting minutes. And this is generally more common in our smaller plans. And this is important because a plan sponsor does have a fiduciary responsibility under the plan to make sure that it's being run in the best interest of those plan participants and its beneficiaries. Some examples of these responsibilities include, making sure the plan is being operated accurately, making sure that the plan expenses being paid from plan assets are reasonable, and evaluating a plan's investment performance to make sure that those investments being offered to the plan are diversified and not underperforming. By having a committee, it just helps to ensure there is a process in place for making these decisions, and the meeting minutes just provides documentation of the fiduciary's actions and decisions. On our website, we actually have it's called a benefit plan fiduciary checklist that I encourage you to look at as well. And it includes a comprehensive list of items that a plan sponsor should be doing to ensure that they are fulfilling their fiduciary responsibilities under ERISA. And we'll be providing a link to that checklist later on in the slide slide deck for you. And that probably covers the top 4. So I'll pass it back to you, Theresa.
Okay, but yeah, thank you, Jennifer. I think that I forgot to mention at the top of the call that I focus in auditing benefit plan audits as well as Jennifer, and those are definitely the most common errors or compliance issues that I see every year as well. So just a follow-up question to those errors and compliance issues that we see, Jennifer. And you did already mention a few of these, but can you share a few specific examples of best practices that can help improve the effectiveness of employee benefit plans?
Sure. Some of these are pretty basic and they're really not hard to implement, but they can be quite effective to ensure that the errors I discussed previously don't happen. One of a common one I see, and I've seen a lot of companies have success with, is using some sort of payroll checklist to document and prioritize tasks to ensure things aren't being forgotten or missed or delayed. And I know it sounds pretty basic, but a checklist can be quite valuable to ensure that some of those items I talked about don't happen. Also, I find, or companies have found that, for some reason, that primary person who's responsible for these payroll duties is gone. That checklist helps provide a roadmap for that backup person filling that role to make sure that things aren't forgotten or missed. When we talk to our clients and ask, why were these contributions delayed, or why were these items on the feedback file missed? One of the primary responses is that, the primary person responsible for payroll was out on leave or on vacation, and there was a backup person filling in that role and they just didn't know. And so that checklist really helps kind of bridge that gap there. Another good practice to implement is just having an annual review of pay codes to ensure that they are in compliance with the plan's definition of eligible compensation. An example of this would be to, at the beginning of each year, compile a list of all the active pay codes that are in the payroll system, along with, their definitions and the purpose, and just making sure they are properly coded as eligible or ineligible based on the definition of eligible compensation. And also making sure that they are set up properly within the system and deferrals are being calculated properly from those codes. I know generally pay codes don't change that often. However, it is still important to have this control because things can get changed inadvertently within the system and go unnoticed. And so it's just a good annual check to make sure that that definition is being followed properly. Another best practice would be to ensure that the participant data, so we're talking about date of birth, date of hire, date of termination, that information that is entered into the HRIS or payroll system undergoes a secondary review by someone other than the individual responsible for that initial entry. And this is important because that participant information plays a crucial role in how a plan is operated. For example, a participant's date of hire or date of birth may determine their eligibility for participation in the plan. Another example is, date of hire or date of termination may be used to calculate the years of vested service, which ultimately determines the amount a participant receives upon distribution. So inaccurate participant data can lead to compliance issues. So just by having that secondary review to make sure that information is accurate can help mitigate that risk of some of these operational errors occurring. Lastly, and I think this is a big one too, is that there should be procedures in place to periodically reconcile the plan records to the record keeper and custodian reports. This would include reconciling contributions per the payroll reports to the contribution totals reported by the record keeper and custodian, including that breakout between, pre-tax, Roth, and each of the individual kind of employer contributions if there are multiple ones. It would also include reconciling total plan assets per the participant detail report that the record keeper provides to the total plan assets reported by the custodian or trustee reports. And lastly, and this one's important, which I think gets missed often because people don't realize that errors can still occur, is just selecting a handful of individual accounts each pay period and verify that the amounts that are deposited in their accounts match what was deducted from their paycheck. I have found multiple instances where, total contributions reconcile and they were remitted, but somehow in that transmission process, someone was allocated the wrong amount, whether it be the person above them in the record, they receive their contribution, or vice versa, or people with the same name, sometimes their contributions can get flip-flopped. So it's always a good check to just select a handful and make sure that what they're receiving matches what their payroll records show as well.
Thank you, Jen. Those are some very useful items that plan sponsors can ensure that they have in practice in their organizations. I'd like to switch topics and talk about tax compliance a little bit. So Rick, a question for you. How have recent changes in tax legislation impacted the design and administration of employee benefit plans? And what should companies be aware of moving forward?
Great, thanks, Theresa. Well, probably the by far the biggest changes recently have been the Secure Act and now Secure Act 2.0 has a variety of different provisions and they're affecting qualified plans, some of which are mandatory, some of which are optional. And so it creates a lot of issues for plan sponsors to either get up to speed with or consider, depending on how they want to structure their plan. One of the issues that has been causing a lot of consternation is the optional provisions, especially, for example, with regard to the super catch-up on elective deferrals in 401k. The standard deferral limit for 401ks is $23,500, but there's been an opportunity for catch-up contributions for people over 50 for some time. That's now been supplemented, I guess, what people are calling the super catch-up provision, which is that if you're between 60 and 63, now you can contribute an additional $11,250 into your 401k plan. But again, this is an optional provision, and so it's creating some issues amongst the plan sponsors and various providers because it's being, I guess, addressed differently by different providers. So, for example, Fidelity evidently is going to basically make that provision standard in all of its documents unless a sponsor opts out. But it may be that the payroll provider is going to take a different approach. And so it can create, this kind of mismatch between the different providers. And if one provider, if the record keeper is doing one thing and the payroll provider either elects not to make that standard, or in some cases, especially for the smaller ones, isn't even capable of implementing the changes by the start date, which is 1/1/2025, then you can end up with a mismatch where one or the other, one doesn't match the other, and it could create a qualification issue if it hasn't been implemented, but the document has been changed to make it available. So that's just an example of how this Secure Act 2.0 is causing some grief out in the marketplace amongst providers. Theresa?
Yeah, absolutely. I am hearing, plan sponsors and record keepers and all service providers talking about Secure Act 2.0. There's so many different provisions there. Thank you for that. So it's time for our second polling question. And as a reminder, you need to respond to at least 3 out of the 4 polling questions in order to get your CPE. So please name one compliance issue that was identified for your plan that affected either 2023 or 2024 plan year. Eligible compensation issues, not maintaining minutes in a meeting, timely enrollment, or choice D, no compliance issues, or at least none that you were aware of. Or for 5, E, if you have other, please put it in the Q&A and we'll see what people put in there. I see late contributions coming in. I see a comment about forfeiture account balances.
All right, let's take a look at the results.
Thank you. Oh, nice. So no compliance issues for about half of you, which is great. And then eligible compensation was the next most popular. And then for the other option, I saw a lot of late contributions. Okay, so we'll move on to our next question. Okay, let's change gears a little and talk about workforce expectations. Brett, what are some key components that organizations should focus on when they are designing a total rewards program to effectively enhance employee experience?
Yeah, thanks, Theresa. Great question, and I think great timing for where we are in the year, because everyone's wanting to know how we pay people different going into 2025. So I think one of the first things that I have realized is that a lot of organizations don't have a very clear, what I would call total rewards philosophy. And the total rewards philosophy is really outlines a couple key elements. Why are we paying people certain ways? And what I mean by that is, are we trying to drive certain level of attraction? Are we trying to engage them? Are we trying to engage them, or maybe we're trying to retain them? Or really is the overall total reward plan focus on all of these things? And what's interesting about that is based on where the market is, total rewards might shift and say, we have a low candidate pool, so we're trying to do more to incentivize the acquisition of new talent and create more of a competitive differentiator and things like that. So that can actually shift back and forth a little bit. I think the second piece is, what are we actually as an organization going to be considering as total rewards? So, when we think about total rewards, it's really a combination of both monetary and non-monetary payments that an organization is making. So monetary are things like your base salary, it could be your bonus, it could be contributions towards benefit plans, 401k, all of these other things. And then it's the non-monetary, which are the perks and some of those other pieces like transportation costs or uniform cleaning or other variable types of non-monetary pieces that the company might be paying towards the employee, but the employee doesn't really see it. EAP is another great example of that. I think the second piece is really, the third piece really on who are we paying? And I think this is really critical because a lot of organizations, when they look at compensation, they really don't delineate roles, responsibilities, and levels. And so different levels in the organization are looking for different things. For example, your executive team is probably looking for something very different than your field team. Your mid-level manager employees are probably looking for something different than your executive and your field team. So it's really critical to really understand the stakeholders that you're trying to incentivize or pay total rewards towards, and really build models that are associated with them. And I think the last piece is, how do we pay? And so from a compensation perspective, that can look at, where are we paying in the market? Are we paying at the 25th percentile, 50th percentile, 75th percentile, et cetera, and really holding yourselves accountable as an organization to meet those specific thresholds. The other piece I would say from a components perspective is really looking at the overall strategy of total rewards. And this gets into a lot of the elements I just mentioned, but really breaking them down in terms of what we look at as short-term, mid-term, and long-term. Or short-term are kind of the immediate gratification, your base salary, your perks. Mid-term are more of kind of annualized things like a bonus. And then your long-term is really exactly what it says. It's your long-term type of benefits and incentives. And a lot of organizations don't have those clearly defined, nor do they have them in an equitable format. So one thing is, you want to make sure is you don't want to lean overly heavily on executive total rewards and not on field or mid-management. You really need to be able to develop a total rewards program that's very comprehensive across the organization. And one of the things I'll talk about in a little bit is really around looking at building more personalized total rewards programs, which is going to be a big trend moving into the next couple of years. But I would say overall, Theresa, I think those are kind of the basic frameworks of what that is. I mean, there's definitely other components around, as you're looking for pay specifically, making sure you're benchmarking and paying, ensuring that your roles are within market, your salary ranges are appropriate. You're creating the right career development and promotional paths and all of these other pieces, which I'll probably spend some more time talking about that in a bit.
Yeah, that's a lot to be thinking about as you create your structure. How can companies ensure that their total rewards programs are aligned with their diverse needs and the preferences of their workforce?
I think the first question, and I know this is extremely obvious, is are they being used? Right? I mean, you think about, and I think this is also really critical when you think about the output of pay or output, a financial output that companies are putting into these total rewards. When you really start doing some due diligence, number one, you'll start seeing where the investment is paying off or where things are being used, but then you'll also see what investments you're making that aren't being used, right? And which could be a cost savings of stop doing those things, or do we reinvest that into other areas? I think some of the big pieces that, employee surveys are a great method for really understanding what the employees want and how those current rewards are being perceived and used. I think the other thing is around making sure that we're listening to the employees, not just based on surveys, but on our own data in terms of utilization, looking at ways to really create more flexible and inclusive-based type of total rewards. And again, I think all of that in a manner, if we can really get in and dive and track and measure those things, are going to be really critical in ensuring a robust and useful rewards, which of course drives to engagement and retention.
Thank you. So a follow-up question on that same topic. What are some metrics or indicators, Brett, that organizations could use to track to measure the effectiveness of their total rewards program in improving employee engagement and satisfaction?
Yeah, Theresa, this is some of these are very low-hanging fruit, but it's funny because a lot of companies don't do them. So are they really that low-hanging, I guess? But I think if you look at them, there's probably some very basic methods of really looking at this. One is overall employee engagement scores. And I think you'd be surprised the number of companies who don't do employee engagement surveys. But part of the employee engagement survey is really around the entire experience and what I would like to call kind of the journey of the employee as they work in an organization. And a key component of that is traditionally compensations and benefits, and not necessarily are you being paid correctly, but really the overall components of the different reward sectors. I think another big one is turnover rates. We definitely see organizations who are lacking in total rewards programs, whether that's underpayment, under benefit type of plans, meaning benefit plans are not competitive with other companies, not matching 401ks and other benefits. You traditionally see a higher level of turnover because companies are looking for those things and they're going to leave to do something else or go somewhere else. The other one is retention rate, so very similar. But what's interesting about retention and turnover is retention is really also going to be hitting the long-term employees. So one of the things you need to look at there is not some of the short-term pieces, but are you really providing the employees with a method to gain wealth, right? And that could be 401k, that could be equity, that could be stock options, that could be phantom equity. We could keep going with that. But it's really around looking at how do you retain the employees. And if you're starting to find that a lot of the tenured employees, and I would say tenure, really 5 years and beyond, are starting to ask questions and leave, probably a good indicator that you want to start diving a little bit more into those packages. And then I think the most important one, which is probably in some cases easy, some places very difficult to measure, is really performance. Especially when we dive into the total rewards around wellness, personal well-being, health, EAP, which is mental health, and others. A lot of these components, you can start seeing how these lack of benefits are impacting the employee's overall performance. And so if we're not providing those necessarily outlets for our employees to get the help that they need. Traditionally, performance is one of the first areas that start to stumble.
Really great insights, Brett. Thank you. All right, now it is time for our third polling question. Emily?
All right, our third question now live.
Thank you. So which metric do you believe is the most important for measuring the effectiveness of total rewards programs in improving employee engagement and satisfaction? And we just heard Brett touch on each of these, so I'm curious to see what the audience thinks is the most important metric. Engagement scores, turnover rates, utilization rates, or retention rates? Please make sure to get your answer in to get CPE for attendance at today's webcast. Looks like we have a few more people that need to respond. What do you think is the most important here, Brett? What do you see if you had to choose one?
I think what I would say is probably the most impactful is going to be the retention and turnover, because you're losing people based on not providing those services. However, the most proactive one is going to be those engagement surveys and listening, so that as you roll those out, you can course correct.
That makes sense. And engagement scores was the top answer, closely followed by retention rates. Mm-hmm. All right, thank you. Okay, so we've covered a lot of information and we're a little bit more than halfway, but I have several more questions to get to our panelists for this webcast. So Jennifer, I'd like to go back to you with a question regarding a topic that I've seen in the news a lot in the last, 6 months to a year. Can you discuss the recent litigation on the use of forfeitures in 401k plans? And what can plan sponsors do to ensure compliance with ERISA and protect against potential litigation?
Yeah, sure. Thanks, Theresa. So before I kind of dive in, just a little background on what Theresa is referring to. Over the last, I would say 2 years, there has been a trend in lawsuits brought on from plan participants, essentially challenging a plan sponsor's use of forfeitures, and specifically to reduce or offset employer contributions instead of using those forfeitures to pay plan expenses. In these lawsuits, participants are arguing that the fiduciaries violated their duties under ERISA because they chose to use the forfeitures to reduce the employer contributions instead of using them to pay plan expenses that are otherwise paid, from the participants' accounts. I think it's important to note that, the practice of using forfeitures to reduce contributions has been permitted by the IRS for many, many years. And in fact, the IRS just recently issued some proposed regulations regarding the timing and use of forfeitures, which they reaffirm they could be used to pay plan expenses. And the ironic thing, Theresa, is that forfeitures are derived from excess contributions. So the fact that they're being used to offset future contributions really seems perfectly logical and kind of goes against logic there. At this point, the plaintiffs in these cases have generally not been successful. There have been a few instances where the plan sponsor's use of forfeitures actually did violate what the plan provisions said in their plan document. And so in those cases, the plaintiffs were successful. I think, in light of kind of these cases, some things that, you can do kind of to protect yourself would be, number one, to, review your plan document and just make sure that you're using forfeitures with how they're written to be used in the plan document. If your plan document says they can only be used to pay plan expenses, you want to make sure that is what they are only being used for. It is common practice, and we see in most of our plans where the plan document will specify that the forfeitures can be used for more than one purpose and not provide a specific order to which they should be used. So an example of this is the plan document state forfeitures can be used to pay plan expenses or reduce employer contributions, but not specify the order into which to be used. So kind of in response to this, you may want to consider adopting a policy establishing a written order in which forfeitures must be used, just to clarify to the plan participants and eliminate some of that confusion on the use of forfeitures. Last thing I wanted to mention as it relates to forfeitures, but that's not necessarily specific to lawsuits, but during our audits, we often find that forfeitures aren't being used at all, and the plan sponsor is allowing them to accumulate year over year and just have that balance grow. Most plans specify a time period in which forfeitures should be used. So by not using your forfeitures annually, you're actually in violation of your plan document, which would be considered a plan operational failure. So I think, for everyone on this call, it wouldn't hurt for you to kind of refamiliarize yourself with the plan documents provision regarding forfeitures, both on how they should be used as well as timing, just to make sure you are in compliance with your plan document.
Yes, absolutely. Both for somebody who's new to being the plan administrator, perhaps for their plan, or someone, who has been in that role for a while. It's good to actually go back to your adoption agreement and or your plan document and look to see what it says and make sure that that is what you're following. Thank you, Jennifer. Question for Rick next. What are some best practices that organizations can implement to ensure ongoing tax compliance in their employee benefit plans while also maximizing tax advantages?
Great, thanks, Theresa. I'd say that from best practice perspective, one thing to keep in mind is that that the plan sponsor is ultimately responsible for compliance, meaning both following the terms of the plan and statutory compliance. When issues come up, compliance issues, there's often a lot of finger pointing because plan sponsors think that the auditors should have caught it, and it's important to remember that the auditors are not doing a compliance audit; they're doing a financial audit, and while they obviously bring things to everyone's attention when they find them, their process is sampling, and they've got materiality thresholds and those kinds of things. So there's often compliance issues that just don't rise to the surface during the financial audit, and then there's the payroll company that is you're dependent on to make sure that it's coded properly and the specific checks are in place to prevent excess contributions and those kinds of things. And so while again the payroll company is retained by the plan sponsor, it's the plan sponsor's obligation to make sure that gets set up right. And then you've got the record keeper who keeps track of everything and does most of the compliance testing. But again, there's always garbage in, garbage out, right? They only know what's being transmitted to them. They don't know what they don't know. So if there are say for example eligibility violations or something, they might never know about it. So it's really important that even though the plan sponsor thinks, hey, I'm paying all these firms a lot of money, it's still ultimately their responsibility to make sure that the plan is set up and administered in compliance, again, with the plan terms and the applicable statutes. So I think, I've seen over the years lots of instances where plan sponsors, I think, depend too much on their third-party providers and kind of view that as a opportunity to check out, and that's not a good idea.
Yes, I agree. I see that as well sometimes, and that is a source for concern. Thank you, Rick. Okay, Brett, a question for you. Something we are hearing a lot about is technology. What role does technology play in shaping the future of employee benefits? And how can organizations leverage it to meet evolving employee needs?
I think Jennifer mentioned, payroll and HRIS earlier, and Rick's, of course, talking about compliance and auditing. And I think first and foremost, technology is now, providing us the opportunity to basically track access, to track any types of transactions, all of these various. So I think from a tracking and management perspective, it is giving us a lot of insight into who's doing what and plan changes and all of these other things. I think the other piece is that when we look at just the overall employee experience, whether they're accessing their own information, their own benefit information, whether that's their benefit plans, whether that's compensation, their rewards, or other things like that, I think just the accessibility, whether that's through mobile device, whether it's through direct access on a computer, has gotten, a lot more. It's provided a lot better experience than it has in the past. And I would say the other piece to that is, when we think about AI, one of the use cases that, we've been experimenting with a lot is really looking at setting up kind of internal AI solutions to act as a plan benefit document, if you will. And so what I mean by that is, an employee can actually log in and ask the AI a question. Hey, this scenario just happened. What am I eligible for? Or, hey, this is the scenario I'm going through. What can I do? What benefits do I have that can cover this? And what that's doing is providing not only easy access, but it's providing a very interactive and accurate approach to helping employees navigate their own benefit programs, which is really key. We talked about self-service, again, and analytics a little bit. I think the other big things that I would just kind of highlight here is that, I think one of the other challenges, and I'll speak this predominantly from an overall workforce perspective, is I think organizations do a really good job at communicating to their employees about what benefits they have. But the reality is that most people are getting that communication through their onboarding process or once a year, and people really aren't listening as much. And so it's just like going through any process, right? Unless you're doing it on a regular basis, you really don't know. And I do think technology and AI and other solutions have been able to bring forward a lot of the employee benefits that are being offered by the employer, and letting employees take better advantage of some of those items, right? So for case in point, a lot of organizations offer EAP. They may mention EAP. They may even mention the details of the EAP, and whether that's wellness, coaching, whether that's mental health support, legal support, financial support. A lot of people don't understand that there's there, and so I think technology has really helped communicate on a regular basis to remind employees what they have, which gets back to some of that utilization piece that I mentioned earlier. Good question.
Yeah, that makes sense. It's hard to value your benefits or use them if you're not aware that they're there.
Absolutely.
Yeah, thank you very much. Okay, we are ready for our fourth and final polling question. Emily.
Right, here's our last question.
Thank you. So what motivated you to attend today's webcast? Please get your answer in to make sure that you get credit for today's attendance. And regardless of your motivation, we are glad to have you here with us today. Please do put a question in the Q&A. And if we don't have time to address it this morning, we will follow up with you after the call and respond to your question. So we welcome your questions. Please do add those to the Q&A.
All right, we'll give everyone just one more moment here.
Thanks, Emily.
All right, let's go ahead and take a look at the results.
Okay, top answer is interested in learning about best practices for employee benefit plans, followed closely by here for the CPE, which makes sense. We are in December. I understand that motivation. Okay, so we've got time for a couple more questions in our last 10 minutes. So Question for Brett and Rick. Talent recruitment and retention is always an important aspect for employers. What emerging trends and workforce expectations should organizations consider when designing their employee benefit programs for the future? Brett, would you like to respond first?
Yeah, I'll talk about from a recruitment perspective. There's really kind of two areas I'll touch on. I think the first one I mentioned earlier is around the competitive differentiator, which is really around evaluating kind of the market, evaluating the various roles, evaluating some of your future hires, and really understanding what's important to them from a rewards or total rewards perspective, and really building out those plans accordingly. I think the second piece, which goes along with the communications aspect, is what I'm going to call the employer value proposition. And the employer value proposition aligns with that competitive differentiator. But I feel like from a recruiting perspective, organizations do not do a good job at clearly articulating the value proposition of working for a company. And so a large component of that is the total rewards and benefits program. And so I think it's a really good opportunity for organizations to really think their quote unquote go to market from a recruiting perspective, and really figure out the best way to highlight and market some of those capabilities.
Thank you, Brett. Rick, what are your thoughts?
Well, in the qualified plan realm, there's kind of a minimum expectation, I think, out there, generally with regard to 401k plans and some type of employer contribution, whether it's a match or non-elective. I'd say something in that 3 to 4% range is pretty much expected out there, especially for medium to larger companies. But there's also some optional provisions that, as part of the Secure Act, that are worthy of consideration. I think one in particular that seems to be getting a lot of attention is the matching on student loan payments. Student loans have obviously got a lot of attention over the last few years, and one of the issues that came to light is that folks that have student loans are really put in a bind because from a cash flow perspective, they don't necessarily have the disposable income to make elective deferrals at the level they would like to. And so not only does that mean that they're not saving for retirement, but they're also not getting the employer match that they otherwise would. So the student loan provision in the Secure Act provides that employers can match on the student loan payments that the employees are making. So at least they're getting the company side of that and making some progress towards the retirement savings. Now, obviously, that is going to increase the cost of the plan to the employer, and there's always a balance there. But I think it also kind of highlights the point I made earlier that not only does the plan sponsor ultimately have the responsibility for compliance, but there are these optional provisions now that it's the employer should really consider, and it just kind of gives them an opportunity to be really intentional about the type of plan that they're providing, what the needs of their employees that they're meeting, and of course balancing the overall cost of the benefit plans.
Thank you, Rick. Yeah, that makes sense. I have been hearing a lot about the student loan provision and the matching there. I haven't seen many clients that have implemented that yet, but I hear them talking about it and thinking about it. So in the same line of thought, follow-up question, how can companies balance the need for innovative benefits offerings with the complexities of compliance and regulatory changes? We have just a few minutes left, but Brett, could you respond first to that?
Yeah, I think we touched on this a little bit earlier. I think the first are local and state federal regulations to ensure that you're being compliant. I think the second piece is really designing those benefits with those compliance regulations in mind. I mean, Rick just touched on the student loan reimbursement and matching and all of those things. And again, those are new and changing, and making sure that you're aligning to what the expectations are. The other piece I would say is, this gets back to the technology piece, is really leverage your technology to help you monitor a lot of the non-compliant activities, or in some cases, the technology is actually providing you with triggers of what non-compliance is. So leverage the technology to inform you on what some of those risks are in terms of putting together some of these things. And I think the other piece I would just say is, honestly, just keep attending some of these sessions to keep up to date on, what these local regulations and laws are. I mean, they're changing so quickly, in the HR and benefit space, and sometimes it's hard to get a hold of. And so the more education you can give yourself, and contacts with, your legal partners or others, are going to be critical.
Absolutely. Thank you. Rick, what are your thoughts?
Well, I'd say leveraging your existing relationships and making sure you're getting the most bang for your buck on the fees that you're paying to the providers. Again, Secure Act's a good example. There are numerous mandatory provisions in there, so make sure you're proactively reaching out to your providers and making sure that you're taking steps to make the important decisions on the optional ones, but especially for the mandatory ones, like the mandatory auto enrollment for new plans, or it's the starting next year, or 26, the catch-up contributions for highly comped have to go into a Roth account. You may not even have a Roth account inside your plan, so it's important to do what you have to do to get it up to date so you can comply with those mandatory provisions. But then also, kind of in the same vein, is to make sure that your providers are working together. And as we said, it's really important that your payroll provider and your record keeper are on the same page with regard to the changing plan provisions and especially the optional ones. So just communication amongst the providers and getting everybody on the same page, I think goes a long way, not only maximizing your investment that you're making in these plans, and both with the contributions and also the provider fees, but trying to mitigate the risk of noncompliance that can get very expensive.
Yes, absolutely. Something that I think all plan sponsors would be in agreement on wanting to avoid. Yeah, and integration among providers is probably easier said than done, but definitely worth the effort put forth to make sure that occurs. Okay, 2 minutes left. So we're nearing the end of our allotted time for today. And the next couple of slides bullet point some key takeaways from today's discussion. So you can download these slides and see the key takeaways from each area that we covered today. So I'll just quickly scroll through these. Just want to make sure that you're aware that these resources are here. And then we do have a slide with links to resources for additional information on the topics discussed today. If you download this attached PDF, you'll be able to click on the links in these documents and receive more information for the topics that were discussed today. Let's see, I think we've got about 1 minute for a question that came in. Let's see, Brett, what are some, and then there are a few more questions that we are out of time for, but we will respond to those separately. Let's see, Brett, what aspects of total rewards do you see employees valuing in the successful workplace of the future?
Oh, that's a fantastic question. I mentioned this earlier. What we're really starting to see is that, one size of total rewards do not fit all. As a great example, the next generation of workers coming in really do not value long-term incentives. They want immediate incentives. So I would say the biggest thing is around flexibility and personalization. So there's going to be some major trends coming out in 2025, moving into 2026, which is going to, I think from my perspective, kind of flip all of these total rewards pieces on its head a little bit, because it's really going to start pushing organizations to think about the various stakeholders across the organizations. I kind of alluded to levels and roles, and really starting to create more cafeteria-based style plans that are really accommodating everyone. Need to be equitable, but people can pick and choose from what they want and what they don't want. The downside with that, what we are potentially seeing is that there might be an increase in costs associated with that, because organizations are going to need to invest in more programs, and you're also going to need more people to manage those programs. But I think ultimately the result's probably going to be higher level productivity, engagement, retention, et cetera. So I think the big piece you're going to see is going to be around personalization and flexibility amongst these different 5 generations of the workforce.
Thank you, Brett. I appreciate the response. And thank you, Jennifer and Rick, for joining today as well. Really appreciated all of your input today, and Emily for helping us, and all of the attendees for joining us today.
All right. Thank you, Theresa, Brett, Rick, and Jennifer, for a great presentation. We are out of time for questions. If we didn't have time to answer your question, we will do our best to follow up with you after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.
Thank you.